Hey there, fellow investors! Ever feel like the stock market is a rigged game? Like some Wall Street hotshots have insider information you could only dream of? Well, I'm here to tell you about a book that might just change your entire outlook on investing, A Random Walk Down Wall Street by Burton Malkiel. This book is a Wall Street classic for a reason. It cuts through the noise and delivers some hard-hitting truths about how the market really works. We're talking about ditching those get-rich-quick schemes and embracing a smarter, more strategic approach to building wealth. Now don't worry, you don't need a PhD in economics to understand Malkiel's message. He breaks down complex concepts into plain English, making it accessible for everyday investors like you and me. Whether you're just starting out or a seasoned pro, this book has something for everyone. So grab your coffee, get comfy, and let's dive into the world of A Random Walk Down Wall Street. Trust me, your portfolio will thank you for it. Let's kick things off with the efficient market hypothesis, or EMH. This is a cornerstone concept in financial theory that has profound implications for how we think about investing and market behavior. Now this might sound intimidating, but stick with me. The EMH is actually quite straightforward once you break it down. The EMH basically says that all publicly available information about a stock is already reflected in its price. This means that the stock prices you see on the market are a result of all known information being processed by investors. That means no fancy analysis or insider tips are going to give you a leg up on the market. The idea is that the market is so efficient that it quickly incorporates all new information into stock prices.
Think about it this way. Millions of investors are constantly buying and selling stocks, each reacting to news, earnings reports, and economic data. This collective activity ensures that stock prices are always up to date with the latest information. All of this information gets baked into the stock price almost instantly. The speed at which this happens is what makes the market so efficient. So by the time you hear about a hot stock tip at a cocktail party, chances are the market already knows and the opportunity has passed. This is why chasing after tips and rumors is often a futile exercise.
Now, this doesn't mean you can't beat the market, it just means it's a whole lot harder than some people want you to believe. Beating the market requires not just skill, but also timing, and sometimes a bit of luck. The EMH suggests that consistently outperforming the market requires not just skill, but a healthy dose of luck as well. Even the most seasoned investors can't predict market movements with absolute certainty. So what's the takeaway here? Instead of trying to outsmart everyone else, focus on building a solid investment strategy based on the principles of diversification, low costs, and a long-term perspective. Diversification helps spread risk, low costs ensure more of your money is working for you, and a long-term perspective helps you ride out market volatility. We'll dive deeper into those later. For now, remember that the market is a complex system influenced by countless factors, and trying to predict its every move is a challenging endeavor. Stick to the basics, stay informed, and keep your investment goals in sight. Ever watch a drunk guy stumble down the street? It's a sight to behold, isn't it? The way he wobbles unpredictably, never quite sure where his next step will land. It's almost like watching a chaotic dance where the next move is anyone's guess. That's kind of what stock prices can look like according to the random walk theory. Just like that stumbling drunk, stock prices seem to move without any clear direction, making it hard to predict their next move. This theory, championed by economist Burton Malkiel, argues that stock prices move in unpredictable patterns, much like that stumbling drunkard. Malkiel's idea is that the stock market is inherently unpredictable, and that trying to forecast its movements is a bit like trying to predict the path of a leaf caught in a gust of wind.
Now I know what you're thinking, but Jim, surely there are ways to predict the market, right? Charts, trends, technical analysis? Don't those help predict where stocks are headed? After all, many traders spend countless hours analyzing past price movements, looking for patterns that might give them an edge. Well, Malkiel argues that those past price movements are about as useful as a broken compass. He suggests that no matter how much data you analyze, the future remains uncertain and unpredictable. He believes that trying to predict short-term market swings is a fool's errand. The market is influenced by countless factors, many of which are impossible to foresee. Economic reports, political events, natural disasters, all these can send stock prices soaring or plummeting without warning.
Think of it like this. Imagine you're at a carnival trying to guess which way a coin will land on each flip. Sure, you might guess right a few times in a row, but over the long haul, your odds are 50-50. No matter how much you study the coin, its weight, or the way it's flipped, each toss is still a gamble. The same goes for stocks. Short-term price movements are largely random and influenced by a million different factors. You might get lucky and make a few correct predictions, but over time, the randomness of the market will catch up with you. The stock market is a complex system influenced by everything from investor sentiment to global events. Trying to predict its short-term movements is like trying to predict the weather a month in advance. Possible, but highly unreliable. The key takeaway here is to ditch the crystal ball and embrace the uncertainty. Instead of trying to time the market, focus on what you can control. Accept that you can't time the market perfectly, and instead focus on building a portfolio that can weather the inevitable ups and downs. Diversify your investments, think long-term, and remember that the market's unpredictability is just part of the game. By embracing this mindset, you'll be better prepared to navigate the twists and turns of the financial world. Now, if stock prices are truly random, how do we even go about investing our hard-earned money? The stock market can often seem like a chaotic place, with prices fluctuating unpredictably, and news headlines adding to the confusion. For many, this unpredictability can be intimidating, making the idea of investing feel like a gamble rather than a calculated decision. Well, that's where index funds come in. These financial instruments offer a way to navigate the seemingly random nature of the stock market with a strategy that is both simple and effective. Think of index funds as the set-it-and-forget-it option of the investment world. They allow you to invest without constantly monitoring the market or making frequent trades. This hands-off approach can be particularly appealing for those who prefer a more relaxed investment strategy. They're like the slow cooker of investing, simple, low maintenance, and they deliver solid results over time. Just as a slow cooker allows you to prepare a meal with minimal effort, index funds let you grow your wealth steadily without the need for constant attention.
So, what exactly is an index fund? At its core, an index fund is a type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a specific market index. It's basically a basket of stocks that tracks a specific market index, like the S&P 500 or the Dow Jones Industrial Average. These indices represent a broad segment of the market, providing a snapshot of overall market performance. When you invest in an index fund, you're buying a tiny piece of all the companies in that index. This means your investment is spread across a wide range of industries and sectors, reducing the risk associated with investing in individual stocks. What's so great about them? Why should you consider adding index funds to your investment portfolio? Well, for starters, they're incredibly diversified. Diversification is a key principle of investing, as it helps to spread risk and reduce the impact of any single investment's poor performance. Instead of putting all your eggs in one basket by picking individual stocks, you're spreading your risk across hundreds or even thousands of companies. This broad exposure can help to smooth out the ups and downs of the market, providing more stable returns over time.
Not only that, but index funds are also known for their low fees. High fees can eat into your investment returns, so keeping costs low is crucial for long-term growth. Since they're passively managed, meaning they simply track an index, you're not paying high expense ratios to fund some Wall Street hotshot's salary. Passive management involves fewer transactions and lower administrative costs, which translates to savings for investors. Those savings can really add up over time, boosting your returns. By minimizing fees and maximizing diversification, index funds offer a powerful combination for building wealth. Whether you're a seasoned investor or just starting out, the simplicity and effectiveness of index funds make them a compelling choice for anyone looking to grow their money with minimal hassle.